And we're live, and I just got this posted to my Facebook. Good morning, everybody. Welcome to Your Business, Your Wealth. My name is Paul Adams, founder and CEO of Sound Financial Group. And I'm left wholly unsupervised this morning with another person who should probably have Corey here supervising the two of us. But as many of you know, he just had his beautiful baby Quinn and is home just investing in that cute little bugger. And we're so glad you all could join us. Today is a little bit special. It's episode 200 of this podcast. Now, it's been kind of an amazing journey. We've loved being on this journey with all of you. We love getting your feedback, etc. And something that we haven't done in a while, I want to remind everybody of right before I introduce our guest, is that we haven't talked in a while about putting reviews on this podcast, sharing it on social media. So if what you do is you're in the iTunes app and you give our podcast a review, just send us a screenshot of that to info@sfgway.com, and we'll send you a copy of our latest book that just released in January, named the same as this show, Your Business, Your Wealth. All right, that handles all of our major announcements of this being episode 200 and us being in the position that we want your reviews and we want you to share this, and we'd love to send you a copy of our latest book. And if you already have one, just let us know that you already have our book, and we will find another great book like The Millionaire Next Door to send you, or my favorite, Stop Acting Rich and Start Living Like a Real Millionaire. With that, let me bring our guest in. And by me, I mean Jordan, the wizard, video engineer, who brings him in from the inner zones into our show, Robert Slattery of Blackwell Real Estate, the founder of Blackwell Real Estate. Good morning, Mr. Slattery. How are you?
Mr. Adams, how are you, my friend? Thank you for having me here.
Man, I think our audience is going to thank me for having you here. Would you mind, just so I don't botch your introduction, just telling our audience a little bit about yourself and your business? And then we're going to dig in and give people some of the basics of what it means to learn to invest in real estate.
Thanks, Paul. I appreciate it. My name's Robert. I am formerly an IT geek. I worked in information technology in the 90s and early 2000s. My passion is taking huge amounts of data and boiling it down to make it meaningful. And that's where Paul and I have found connections along similar lines. In 2003, I left the IT world to figure out how to squeeze a buck out of this thing called real estate. And I started out on the brokerage front. But my passion was not figuring out how to sell houses or list houses. It was how to make money using rental properties. And between 2003, 2008, I pursued the easy money, which nowadays would be more like flipping, or we'll talk about that. And when 2008 came and the market correction came, I got my clock cleaned, which was really a lot of not fun. Over the next 4 years, I had to rebuild my own financial situation and my model. And I was good at finding properties that made sense, but I was approaching them from the wrong direction. And when I made a little bit of a shift to focus more on cash flow, it made a tremendous difference. So between 2011 and 2015, I rebuilt my own financial situation and my business. And then in 2015, we had a series of events happen that inspired me to open Blackwell Real Estate. We are a one-stop real estate company where we offer people the ability to plan out what they want to do. We help them acquire properties to meet their plan. And for those folks who don't want to do it themselves, we offer property management services. Then we're able to go back and look at their plan and see where they're at, maybe go and acquire or readjust their portfolio, manage, stabilize, and then you get a business system that just repeats itself until somebody reaches their goals of financial freedom and independence. That's what I do.
And if you do that enough time, it's really great for rehabbing your rotator cuff. So
indeed,
it is the real estate of wax on, wax off, brought to you by Mr. Miyagi, played by Robert Slattery. Okay, so when people are investing in real estate, people do things terribly wrong. And one of the things I'm a big believer in when you're trying to get good at something is the first thing you have to do is stop doing the things that act against you. So if somebody's learning to play chess, a complicated game like chess, or Go for real big strategy, the first thing that you do when you're learning is your coach would tell you all the things you need to stop doing, the things that you're doing that detract from your ability to do that. And the thing that we bring up to clients is one of the first things you got to do is educate yourself about real estate for this reason. Real estate is one of the only assets you can have on your balance sheet that can make demands of other assets on your balance sheet, which is why it needs to be very strategic and well thought through. Now, I'm kind of surprising you with this question a little bit, Robert, but what do you find when you run into somebody who, let's say, is like, I'm never owning another rental property again, they've had that kind of bad experience. From your perspective and what you've noticed over your career, what are the biggest 1 to 3 mistakes you see people just get hammered by when they try to invest in real estate, like the worst self-inflicted wounds perhaps?
I actually have a promotional flyer that I've put together, the 5 biggest mistakes people make when buying a rental. So I'll just give you 3 of them. The first one is they start without a plan, and you just touched on that. You have to have a plan. Long before we ever talk about real estate, about apartments or duplexes or fourplexes or apartment buildings or anything, we sit down with somebody and say, okay, what is it that you're looking to accomplish? And they say, well, I want to own rentals. No. Why do you want rentals? And we take it backwards from there. I'm one of those guys who the rentals are behind the curtain over there, and we'll get to that. Let's just talk about what it is you're trying to accomplish. And the way that I frame that question is I ask people how much money they're looking to make each month to live their lifestyle, because rental properties are a great way to replace your income if you do it right. So number 1 is they don't have a plan. Number 2 is they don't treat it like a business. They say, I'm going to go out and buy a rental property. And that is about as far as the plan and the strategy go. They go out and they buy a house, and they don't really know what to do with it. Well, you put it up on Craigslist, or you put it up on Facebook, or you find a renter, and hey, I know a guy at work who might want to rent it, so maybe I'll rent it to him. And I think I want to make this per month without doing any market research, right? They didn't do any research on what demand is in the area. They didn't do any research on what market rents are in the area. And they didn't do any research on what the right property type is for them. And so they're just kind of running this impulsively instead of like a business. The third thing that I'll mention is that most folks don't plan for maintenance. They don't put together a maintenance plan for the property. So I've got a 7-week workshop where we talk all about this stuff. But maintenance, when you buy a property, it's best practices to always have an inspection. Always have an inspection.
How often should we have an inspection?
Well, not necessarily, but just really kind of always. Always. Never waive your inspection. Never waive your inspection. And here's why. You get a report from your inspection. And yeah, there's always going to be scary stuff in there, because that's the inspector's job, is to tell you everything that they can find wrong with that property. But you know what you do is you treat it like a business. You say, here's my report, assuming I'm okay with moving forward with buying this property. Now, how do I go through and plan to address these things? And then you have to figure out how you're going to pay for it, which is also part of the strategy. So the 3 things that I would say, they buy a property with no plan. They don't run it like a business, and they don't have a maintenance plan. They don't know how they're going to address maintenance issues.
So one, I love this as a starting off point, and I just in my lexicon, the way I would reword the first one is they have no aim, or they're aimless. Like, I'm purchasing this for the sake of what? And you're right. So many people don't have that. They don't have that. And this is just normal for all of us. We so often supposed to do that. I'm supposed to put money in my 401k. I'm supposed to do this. Or somebody shoulds all over us. You should do this. You should do that. You should have one of these. Or sometimes they should all over themselves and say, I should be doing this. I should be doing that. And so they'll take action due to self-induced or societal pressure without really knowing what the outcomes are. And then I love the second one, because the second one of not treating it like a business is what we've been talking about on this podcast for years, is this ability to people that it is one of those things, especially if you're higher income, you've got good credit, it is amazingly easy to enter in, like in a matter, I suppose if I went after it right now, I could go out and secure a $2 million real estate portfolio almost overnight just on my income, not even needing the financials of the properties to make sense to the bank, just because we have such a low debt to income ratio. And the higher income you are, the bigger trouble you can get yourself into more rapidly. And then this idea of maintenance, man, that's one we all forget on everything. You know, start a project and not think to yourself like, I'm one of those guys who's notorious for being able to say, we can build a fence here, and I'll even help you dig the first 2 post holes. If anybody's ever used a post hole digger, I love my buddy Kirkland Tibbles puts it, it is the devil's device. Like, nothing gives you as much pain every day as using a post hole digger. And I will do the first few, show people how to do it, but then I need to walk away and somebody else needs to do it. But I still have to have a plan that somebody on the team is going to maintain whatever it is. So let's tack back to the very first one about having an aim, having a reason for why you're buying the property. So when people don't have that, would you say their bigger problem is the thing that breaks down for them if they don't have a plan for it is that they may acquire the wrong property, and or they will bail out of real estate as a strategy too early when they hit their first bump in the road because they didn't have a long-term aim? Or what do you find is the biggest breakdown in the first one?
Well, Paul, I don't know your experience, but in my experience, investing in real estate is always easy and always smooth. Is that not how it is over in your stock market?
That is, yeah, just smooth and up and to the right, just every time, no problem.
Right. No, in fact, I talk about this. I get so many questions about this that I mentioned earlier. I built out a 7-week class that just deep dives into this. And the first week of the class is all about finding your why, setting goals, and using that to build your plan. And I actually took my model for my course from Dave Ramsey's Financial Peace University.
We won't hold that against you. He's the greatest financial entertainer ever.
Anyway, I took down his book. I put your book up back here.
Oh, look at you. Man, you are a gem. I saw the book earlier, and I was going to say something about it later for fun, and I didn't even notice how craftily you switched them out earlier.
I'm sneaky like that. No, man, you gotta start out with your plan, and having a plan is non-negotiable, right? So when I meet with somebody, they come to me and they say, I want to make money using rentals. I say, why? And that puts them on their heels a little bit for the most part, because they don't want to be challenged. They just know that conventional wisdom says you should own rentals, so they should own a rental. And I say, okay, what does that mean to you? Because I know what it means to me, but I want to hear it in your words, what you're looking at. When we start talking about this, what we do is we end up fleshing out that usually they feel like they're lacking something. And what it is they're lacking is either some form of financial security, some form of societal ranking, or something like that. But they feel like they're missing something, some component of their self or their investment portfolio is missing. Great. And then I do what you do, and I take it back and I reframe it for them. And I say, well, okay, the reason that I am into rental properties is because you build long-term wealth and cash flow. And the way that we do it is we analyze properties based on cash flow. We factor for appreciation. We look at depreciation and the benefits therein. And we look at the benefits of debt reduction. Now, there are these nice people called tenants who are going to give you money every month if you buy the right properties in the right location and you maintain them so that they're clean and safe and a place where somebody would want to live. It's really not that hard. And then I reframe the entire discussion by asking them the question, how much money do you want to make each month to live the lifestyle you want to live? And that also puts people back on their heels because they don't think in terms of that, right? This podcast is talking to higher net worth people, right? And so let's assume that you're making 15, 20, 30, 50 grand a month, whatever you're making. Okay. Well, we start talking about, does that allow you to live the lifestyle you want to live? Out of hundreds of these conversations a year, I'll tell you the average answer I get is around 10 grand a month to make $10,000 a month. And I say, fantastic. It takes my typical client, I don't deal in average. It takes my typical client between 2 years and 3 years to build the $10,000 a month portfolio, with some exceptions one way or the other. Now there's still debt attached to it. That's on the gross. But then we're able to use some different advanced strategies, one of which you and I have talked about at length, to get that portfolio free and clear, usually in about 5 to 7 years.
So let's wind back where somebody says, when you ask the why do you want real estate? And I think this is what I want all of our listeners to notice is, if Robert was asking you that question right now, you're driving along in your car, you're working out, whatever you're doing, and you're thinking of some financial decision, and it may not be rental real estate, but that question of why, for the sake of what part of your aims is that going to meet? What I notice is when somebody asks me a question that's not a closed-ended question, it's not yes, no, it actually gives me an opportunity to locate myself in my ignorance. Because until somebody asks me a question like why and doesn't lead me into anything is when I find out that I didn't have a why for that thing. Maybe it was a habit, or maybe it was that supposed to or shoulding. And so I love that. And that idea of having an aim around the passive cash flow from the real estate, to me, is the thing I think a lot of people miss. We were talking just before we went live about real estate operating like a business. And this is the question that came up. I was just chatting with a guy. We went to not a skate park. What's the right term? Roller rink now? Is that what they would call them? I don't know. It was super noisy and I had to wear a mask. So my kids loved it though. But while we were there, I was talking to another dad in our homeschool community. And one of the things just hit me is how often people don't buy real estate like a business. But this is the one that I've seen, and I'm curious how you look at it as well, is that people will buy a property and say, well, I think it's going to appreciate, and so I don't mind that it's $200 negative a month or $500 negative a month. Or, I kid you not, we reviewed a real estate deal that was this beautiful condo in New York that was going to negative cash flow, but it was going to appreciate over time. This neighborhood, of course, the agent had told them all the wonderful things, and it was negative about $600 a month. Now, the client household made about $800,000 a year, so they could take it. I think that's one of the problems with having a lot of income, is you can get yourself into worse trouble. And they closed on that, I think, like middle of 2019. Which is a little rough in a pandemic year, that it is negative cash flowing much more than that $500 a month. How do you look at that when people or other real estate agents out there are like, oh no, we can go into it, it's okay that we're losing a little bit of money every month, or it's only break even because appreciation?
What we teach is that there's two ways to make money in real estate, right? You've got equity growth, which is your appreciation, right? And then you've got cash flow. And they're both on the same scale. And most investment models are going to be some combination therein. And what you're talking about is what I did from 2003 to 2008, where I was heavy on the equity growth. In fact, I was negative cash flowing my portfolio because I wasn't making $800,000 a year, but I was doing about $250,000 a year, which was a lot for a guy in his early 20s. And I didn't care about the negative cash flow until the market stopped supporting it, and the rest of my business also took a hit.
Mm-hmm.
At that point, it became a lot of not fun really, really fast. And so when I retooled, I went heavy to the cash flow side. And what happened was I started analyzing these properties based on cash flow first and foremost, and then I would start looking at what appreciation would project out. We are blessed to be in the Puget Sound, in the Seattle market, where we've had double-digit appreciation for over a decade now. That's great. But what happened was when I was focused primarily on cash flow, the numbers had to make sense from day one. We do not advise clients to buy negative cash flowing assets ever.
Well, like you wouldn't buy a negative cash flowing pizza joint. It's going to cost you $1,000 a month to own because you think pizza joints are going to go up in value and you hope to sell it in 5 years for a profit.
Okay, and let me qualify this. I have a client named David who just bought a fourplex in Tukwila over by South Center. And the property is not cash flow positive because it has 2 vacant units.
Mm-hmm.
It has 2 units because he has moved out 2 of the tenants so he can renovate the units, improve their quality, adding about $200,000 in market value to the building, and then he'll be cash flowing $1,500 to $2,000 a month positive cash flow. So I don't advocate anybody buying negative cash flow investments. I've looked at buying properties in Hawaii. We've looked at the Honolulu market. We've also looked at Maui. And we have, there's a condo in Maui that a client of mine owns that I keep telling him I'm going to buy. Hawaii is a unique market, not dissimilar from New York, where you were talking about people buy properties expecting to hopefully break even.
Mm-hmm.
In the equity growth, they're hoping the value of the property is going to go up over time. And that can work. For me, I need the cash flow. I need to see some positive results coming out of the property. And if nothing else, I want, after I write that check, after I feel the pain of writing the check or sending the wire, as it is now, to close on the property, I want that to be the last major cash I put into any property. I want my tenants to pay for everything else moving forward. You can't do that in a negative cash flow situation.
Well, and I think to your point, like if we were going to buy the pizza joint and it was negative cash flow, we wouldn't buy it until we already thought through, oh yeah, that manager's maybe overpaid, or I'm going to manage it myself. We're going to make these changes to the marketing, which will then make it profitable, just like buying a property that's negative cash flow at the start. But what you're doing is deploying new value. You're adding value to the exchange, therefore you get a higher return. And that's the thing that bugs the daylights out of me on the appreciation only play, is there's nothing you can do to control that. You can absolutely control what the accommodations are like, how you recruit tenants, the way that you write your leases. There's all kinds of control on cash flow and almost no control of the appreciation. You can make improvements that the marketplace might like, but that's not huge returns.
Right.
What, so we've got which this reminds me, we're nearing up toward the end here, a few more minutes. I totally forgot to do any promotion or commercial. So with that, here's just a little reminder to everybody. That white paper that Robert just talked about, if you guys want that sent to you, just email us at info@sfgwa.com or sfgway.com. We also have that domain now. You can email that over, and then we will return that back to you, and we'll even CC Robert on the return for you. So if you want to get connected with Blackwell, you can do that. We make no endorsement of any particular investment or investment provider, and whatever the heck else I'm supposed to say for compliance reasons, which is also in the disclosure. So you guys read that disclosure. All right, Robert. So somebody shows up, they're talking to you, and let's just for the moment say this is somebody who's making $400,000 a year, but their burn rate on capital for their household is $200,000. From the way that you see it out in the marketplace right now, what are the markets that you see people being able to purchase in? Because I know that you do business in multiple states for just the reason that not every market has the best, let's call it, profile for being a landlord.
Absolutely. I've got clients who talk to me about Oklahoma City, and we are not active in Oklahoma City at this moment, but I hear about Kansas City and I hear about Nebraska and all these different places. I have focused our attention on major metropolitan markets that are going to remain economically sound even through some turmoil. So if we have another correction, and I know this never happens, economic corrections don't happen, but when the next correction comes, yes, it's true there are some markets where you can buy a $40,000 fourplex and in theory make really good returns on it, but those are also the first markets that usually get hit bad when a correction comes. And so we focused primarily right now, we're in the Seattle market, obviously the greater Puget Sound region. We are active in Boise. We're active in Denver. We've done some work down in California. We are opening Dallas, Fort Worth, and we're going to be looking at the Austin, Houston, and possibly San Antonio markets this year. That'll come online here in about 4 months. And I've been in Florida once so far this year. I'll be in Florida again next month. We're looking at the Tampa, Orlando market, and then possibly opening up Miami. After that, we're going to be looking into what I would consider
you're going to need a bigger plane to fly to Miami.
Well, that's a different discussion for another time. But we are in negotiations right now looking at Phoenix. We're looking at Atlanta. And then we're looking at some strategic markets in Kentucky, Tennessee, South Dakota, Wisconsin, and New Mexico. So what we're trying to do is build a database of first information, because I'm an information guy. And second, I want to be able to help folks wherever they're starting. So you're talking to people who are making $300,000-$400,000 a year or more. Okay. I also work with people who are making $80,000 to $150,000 a year combined household income. And we have opportunities for folks starting across the gamut. I've got folks that are making over $1 million a year that come in and they buy 4 properties a year with us, and we stabilize them. Then the next year we do the same thing. We just wrote a $3.5 million offer for one of those clients on a 35-unit apartment building. The deals are out there. The goal that I would encourage folks to focus on is first, figure out if you're okay investing out of your immediate market. Okay, back to our friend Dave Ramsey. He says if you can't throw a stone and hit it, you probably shouldn't own it. All right, I think that's great advice for your first couple rentals. But after that, there are better opportunities in other markets. I own apartments that are many hours away, either by car or by plane. And I'm okay with that, because if you have good management in place, which is part of your business, and everything should be fine, right? There are too many folks who approach this. The Oklahoma City folks have one real estate broker in Oklahoma City who finds the properties, manages the properties, coordinates maintenance on the properties. And I say to them, what happens if that one person gets hit by a bus? Or worse yet, you guys work them to death and they have a massive heart attack. Then what? Now you own all these properties in Oklahoma City, right? Everything's fine when everything's fine. So I would encourage folks to first focus on where they are comfortable investing. And if you start in your world, I think this is beneficial, because where you're at, people don't care where the mutual funds are located. They care what the returns are on them. And what we are doing here at Blackwell is we're creating a similar structure where folks own their own assets. We do not syndicate. They own their own assets, and we help our clients acquire properties where they are comfortable, as long as they meet our criteria.
Well, and that's something that I think, and I'd love to hear from you guys in the audience if this would be helpful. One of the things that Robert does is they do real cap rate calculations. If you guys listen to some of our past episodes, you know what a cap rate is on a commercial property. Commercial investors are often far more disciplined than individual investors. And he uses that cap rate calculation to help an individual investor buying a rental property, how that's cash flowing the same way the big boys would do it if they were buying a $100 million commercial center. And he's made it simple and bite-sized in a way. So for all of you out there, either email us or put it on one of our socials, to mine or the company's. Let us know if you'd be interested in a micro lesson like that, and we'll just record something we can put up on them inner zones that's like a 5-minute micro lesson with Robert about how to calculate that cap rate on a piece of real estate. And one, Robert, thank you so much for being here today. And second, thank you so much for me volunteering you for that micro lesson without your permission in advance. So hopefully people ask for it, and then I can have the uncomfortable conversation with you about us having to fulfill on my promise. But how can people get a hold of you so that they know if they're in a situation, maybe they already have some rentals and they're like, I should probably take a look at the difference between my return on equity and my return on investment? Or are they working well? Or I'd like to get my toe in that water but I need solid guidance and help. How can they find you?
So three things. The first is I'm going to plug my online workshop. It's a 7-week workshop. It's 1 hour a night for 7 weeks. It's blackwellworkshop.com. The next class starts. The classes are every 2 months. So look it up at blackwellworkshop.com. However, most people listening to this podcast don't have the time for 1 hour a night for 7 weeks. And I get that. They're also sitting on a bundle of cash and they're ready to deploy. They want to do something. For those folks, we're putting together a special 3-day event. It'll be at the Dallas-Fort Worth Four Seasons in August 25th through 27th. And we're going to go through everything they need to know to first build their plan, execute the plan, and likely get their first rental property under contract with myself and my team. That'll be blackwellbootcamp.com is the information there. And if somebody wants to contact me and have a conversation, just hit my calendar, robertscalendar.com, and I'm happy to schedule a call with you.
Right on. Well, thank you so much. You can also find him on Instagram, Facebook, LinkedIn. Look for Rental Property Wealth Coach. Thank you so much, Robert, for being here. For all of you, I'm just so glad that I got to spend 200 episodes with you. Aside from me missing just a couple where Corey's led them while I've been out of town, man, I didn't expect to almost cry. But it's meant the world to me that all of you would be here with us through this journey, getting a chance to hear what all of you who are listening are doing, the difference you made to others by sharing an episode, the difference it's made to you personally in understanding a financial concept that when you're working with your Sound Financial Group household financial officer didn't click, and then you were able to dig in and take in an episode while you were on a drive and the lights came on. All of that wouldn't be possible without all of you listening, without all of you sharing, and certainly not without the incredible team here at Sound Financial Group. So to everybody at Sound Financial Group, to my loving wife and supportive family, and to all of you who have made this show a success, I just want to say thank you from the bottom of my heart. And I know that comes from Corey too. And I would express how Corey's feeling, but then I will full on bawl. So to everybody out there in the world, and from all of us at Sound Financial Group, we hope that this episode has been a contribution to you being able to design and build a good life.